You're watching Economics Amplified, the latest thinking on the biggest issues from UChicago's Becker Friedman Institute.
Today we're lucky to hear from Rob Engle, and he's the Becker Friedman Institute's Tai Chong Lu Distinguished Visitor. And Rob has had very important contributions related to time series analysis and a long-standing interest in financial markets. He has been the innovator of ways to measure volatility, and he's been an innovator in terms of how those measures are used in insightful and useful ways for a very, very wide variety of purposes. He's a 2003 recipient of the Nobel Prize in Economics, and he's currently the director of the NYU Stern Volatility Institute. And he was the co-founding president of the Society for Financial Econometrics. And I could go on with a bunch of other things he is as well. But he's a truly distinguished scholar, and I personally look forward to hearing from him. Thank you.
Well, thank you, Lars. It's a great pleasure to be here. This is a pretty special day with the ceremony for the Clark Medal going on out in front, and chance for me to speak with you a little bit today about some of the stuff that we're doing at NYU. What I was going to do today, this was listed as a conversation, so I'm going to think of it like it's a conversation, but it's a conversation that's got a sort of a web interface to it. And so I'm going to talk about risk, monitoring risk, and I'm going to talk about monitoring risk with VLAB, where VLAB is this website that we have constructed. And what this website does is it takes data from financial markets every day, builds forecasting models for volatilities, for correlations, for a couple more exotic things like measures of systemic risk and measures of long-run risk, and then reports them. And so it's a fun way to talk about current events and to see what's going on in the economy, what's going on in financial markets, and we'll take a look at some of the places where volatilities are changing. So let's take a look at what we've got here. So when we set up this website, the idea was we were going to put our current research topics on this website, and then we would estimate a volatility model or something like that, and it would be re-estimated every day or every week or something like that without human interference. Now, as academics, we don't usually do that with our models. We don't usually suppose that without changing the model, you could re-estimate it with new data. It's kind of the ultimate of out-of-sample performance because we don't know what's going to happen in the future, and we don't know whether these models are going to work. So our thought was this would be a great new type of research tool to try to figure out which is the best volatility model, or what's the best correlation model, or what's the best model of some other kind of risk. But it's turned out that it's also a very useful tool, first of all for teaching, but second of all for risk managers, and now it turns out regulators are finding this a very useful tool as well. So let's take a look at what we've got. There are really four sections of VLAB that we'll talk a little bit about: the volatility, correlation, systemic risk, and long-run risk. And so we're going to take a look at each of those. This is what you see when you go to the welcome page, and if you don't remember the web address, you can just Google VLAB, because fortunately we've got enough people who have done that we're now at the top of the list. And so it'll come up right away. So here we have the four sections here: volatility, correlation, systemic risk, and long-run value at risk. And if you run the mouse over them, you'll switch from a welcome page for volatility to welcome pages for the other things. And here you see what the volatility looks like for the first index, which is the Standard & Poor's 500, over the last month. And, you know, some of you don't maybe know exactly what I mean by volatility. So let me just give you an idea. When you talk about the stock market, every day there's some announcer that comes on at the end of the day and says the market was up 2% today, or it was down 1%, or it hardly moved at all. Well, if those are big numbers, whether they're positive or negative, we say the volatility was high. If they're small numbers, you say the volatility is low. It didn't change very much. So what we're really asking is, what's the amplitude of the surprises that happen in the stock market? So if the amplitude is big, that means there's a lot of stuff happening and there's a lot of risk. There's a lot of possibility that your investments could either go up or down a lot. So what you see is that the volatility here was coming down starting in sort of mid-March. It's coming down, and it came down as low as a measure as 10%, which is sort of the annualized standard deviation of volatility. But then we had the beginning of this tech sell-off that, as well as the result of the Crimea adoption, I think. And you see that the S&P volatility increased quite substantially starting about a week and a half ago. If you look at these other indices, we've got the FTSE and the DAX and the CAC and the euro versus the dollar, the yen versus the dollar, and then world and emerging market indices. You can just kind of get a quick picture of what's going on, what's been going on over the last month. But we can go into a lot more detail. One thing we could do would be to look at the sectoral, what happens to different sectors of the economy. And so when there's green, it means that the volatility has gone down since yesterday. When it's red, or whatever color this is, pink, it means it's gone up since yesterday. So this was a table I did 2 days ago. So volatilities went down for all sectors of the economy. And actually, it's fairly common for volatilities to move together. That when the volatility for the whole economy goes up, pretty much all these sectors will show increases in volatility. And when volatilities for the whole economy goes down, which is what it was happened on this particular day, you see they're all pretty much going down. So here is a typical picture of what you can see when you look at the volatility. The bottom is the data, and the green line is what the S&P has done. This is since January of 08, and you can set the dates here to whatever you want. I guess I'm looking before the financial crisis, so it's April of 07 is the starting point. And so you see the S&P went down, and then it came up, and this is the little tech sell-off that we're talking about right at the end here. But what's in blue is what we're really looking at when we look at volatility, which is how much it changed from one day to the next. And so when we want to talk about volatility, we're talking about the amplitude of these things. And you see it's pretty small, except when you get back down here. This is the summer of 2011. This is when we threatened to default on the debt, when Europe declined into fairly serious episodes of the European sovereign debt crisis. And then we have, this was where the flash crash and the first Greek bailouts took place. And here's the financial crisis. The worst of it was around the fall of 2008 and the spring of 2009 after Lehman's bankruptcy. But you see, actually, it was fairly high for the year before that, but before that it was quite low. So over time, volatilities change in ways which are really quite important and revealing about how the financial markets are really working. And with change in volatilities comes change in risk. So in the top curve is a model estimated on this bottom data, and it tells you how high the volatility is. And here's this 10% number that I pointed to before, and we looked at just about a month of it before. But here, if you look over the sweep of time, you see this high volatility in the summer of 11 and high volatility during the financial crisis with much lower volatility going into it. So this is the kind of thing we can look at. So let's look at a few things. Okay, you got this picture in mind. You understand the pieces of it, how to interpret it. Everybody's on board. Okay, good. Okay, so here is the same picture, but I've added another series on it. We've added the VIX. You may know that the VIX is a measure of volatility that's derived from options prices, and it's a forward-looking measure of basically implied volatility. And what you see is it pretty much moves with the Garch volatility. There is a sense in which the Garch is always a little bit lower than the VIX, but not always, but that they go up together. And so they're estimated on completely different data sets. So it's interesting that they're mostly the same, but there are some differences. On the top, we've got, if you're an econometrician, you might be interested in knowing what the parameters are of this model. They're the parameters in the t-statistics. You might be interested in knowing what the news impact curve is. And what this means is on the last day here, when we're trying to predict tomorrow's volatility, across the bottom we have what the stock market return, the S&P, does today. So if it's 0, then we're going to predict that tomorrow's volatility is going to be 16%. If it's a positive return, we're going to predict, again, 16%. But if it's a negative return, we're going to predict 20, 22, 24, 26, 30%, some large amount. If it goes down 5% in a day, which is pretty unusual, we would have a much higher volatility the next day. And so what you see is that this is asymmetric. It means that down moves of the stock market predict much higher volatility in the future compared to up moves in the stock market. It's one of the intriguing stylized facts which have good economic interpretation, but it was first revealed quite clearly by the econometrics of allowing this news impact curve to treat positive and negative returns separately. And then here's the forecast. 1 day ahead, a week ahead, a month ahead, 6 months, and a year ahead. And what you see is it's predicted that volatilities will come down over the next month or year a little bit. I mean, they're coming down to something less than 16%. And this is a prediction that we call mean reversion, that ultimately volatilities, if they're high, will come back down. If they're low, it'll go up. It's not a very sophisticated prediction, but it's what typically we see in broad brushstrokes. So let's look at a few other things. Here we have the Amsterdam Exchange in red, the Brent crude oil in blue, Barclays AA bonds, AA bond index in green, a REIT index in purple, a government bond index in orange, the euro in brown, and the VIX in purple. Okay, that's a lot of information on one graph. But what you see is that there's some of these that are very small. So we have very low volatility for the bond prices. And it's one of the reasons we think of bonds as a relatively safe, low-risk investment. A little higher is this brown one, which is the euro. That's the currency. So currencies are pretty low volatility as well. But you get things like the real estate index, and you see it had volatility up at the peak of the financial crisis close to 200%. So this is an index that in the financial crisis it was very risky to be holding REITs as part of your portfolio. Okay, so we can follow things like that, but it's kind of interesting to see how these all move. Well, how about Russia? What happens to the Russian stock market? Well, what you see, and I'm just looking now at I think 3 months, so I get to see every day on this. If you look at the Russian stock market, the index is actually the MICEX, which is, you can see, had a big negative return here. That's the day after Putin took over the Crimea, responded to Russians who wanted them there, whatever. Whatever the explanation is, the stock market took it very badly, the Russian stock market. So you see a big spike up in volatility. But one of the things that's followed that, you see the volatility has been falling ever since. So even though the tensions have not gone away, the stock market has not had such big negative days since then as it did right at the beginning. And actually there was a day of recovery right immediately after that first Monday. So did the volatility model sort of overreact? Well, it reacted as if there was going to be one event, but there might be more. And if this invasion in the Crimea had been followed by taking a serious piece of eastern Ukraine, it would have continued up. And so I think the investors moved the stock price and moved the volatility in a way reflecting the possibility that this was not the worst thing that was going to happen. It was going to be more that was going to happen. When things kind of calmed down a little bit, the volatility has come back down, and it's still higher than when we started, but it's come down. So what else is on here? Well, I've got, in purple, I've got Gazprom, which is the national oil business, and in green I've got the ruble. So you see the volatility of the ruble only went up by a little bit compared to the stock volatilities. If you look over the longer period, this spike that we just saw is not actually as big as what happened during the financial crisis. And if you look at the financial crisis, you see we're talking about 150 or more % volatility for the Russian stock market during the financial crisis. So that was more volatile than the US, even though the financial crisis was really a kind of a made in USA financial crisis. But it's very noticeable on this scale, but it isn't the biggest thing on the scale. Now you might also wonder what's happened to the other Eastern European stock markets. So here we've got the Budapest Stock Exchange in blue. And you see its volatility went up about in the same period. And the Kazakhstan Stock Exchange in green. And it did something about 2 weeks ahead of time. I don't know quite what that was. And then went up again during the Crimean crisis. Bucharest, India, and Poland's Warsaw Stock Exchange. The only one that didn't move was India, which maybe is not surprising, but it's clear that it's not an emerging market phenomenon, because then probably India would have moved as well. So, but you know, this unrest unsettled investors in all these Eastern European countries. We have CDS volatilities in here. And so here I've got the volatility of the CDS for Bank of America as well as Bank of America's equity volatility. And from some simple models, those should be about, you know, closely related. And you can see there is a relationship, but it's not that close. So let's look a little bit at correlations now. Here is a picture of commodity correlations. So I've got 3 correlations are, of course, between any pair of assets. So I've got correlation between the S&P and aluminum spot prices, between the S&P and coffee spot prices, and S&P and oil, Brent crude oil. So there are 3 correlations here. Here is 0, so that they're uncorrelated if they're equal to this, and positive is above and negative is below. So you can see these correlations move around a lot, but around the financial crisis, they all of a sudden started moving together. They actually became negative at first and then shot up, moving to being quite high relative to their past levels. And we have about 20 or 30 commodities in this database. So one of the things you might be interested in knowing is, do all of their volatilities move together? Do all the correlations move together? So in the bottom here, I've got a picture which, let me try to describe what it is. If you have a lot of assets, you might be interested in what the whole correlation matrix looks like. You've got all the pairwise correlations for one day in this matrix. We can do something like what we call principal components, which is to look at how many factors are really needed to make this correlation matrix do what it's doing. And if the answer is it only takes one, this is the amplitude of the one, the first one, this orange one. And as you can see, it's about half of the volatility at a peak and less than half of the total volatility when it's lower. The second one is in green, and then there are, I guess, 28 more, if there were 30 assets here, that make up the remaining balance. So one of the things you see here is that the first principal component becomes much more important in this period around the financial crisis and thereafter. And now we see, as we get to the end, there's more diversification across these correlations. It's also interesting to look at correlations across asset classes. And so, for example, in blue, we've got the correlation between treasuries and stocks and bonds. What is that correlation? Well, today it's about minus 0.5. So stocks and bonds are negatively correlated today, but there are periods when they're positive. And actually, if we'd gone back longer, we'd have seen a lot of periods when this correlation was positive. But mostly, it's been negative. When the stock market goes down, the bond market goes up. When the stock market goes up, the bond market goes down. So, when you're worried the stock market's going to go down, you might have a flight to quality by investing in treasuries. But other than that, you don't. But of course, in this period, the correlations were actually pretty close to zero, and that's a good chunk of the quantitative easing period. So that seemed to increase this negative correlation. This one at the bottom is the correlation between the VIX, that is volatility, and the S&P. So it's one of the most reliable and most negative correlations in the data set. So when the VIX goes up, markets go down. And when the VIX goes down, markets go up. They move in opposite directions, and that's a pretty reliable negative correlation. The thing that we often rely on for some protection is gold. So the black line is the correlation between gold and the S&P. And what you see is, for a lot of the time, that's actually positive. So that, when the stock market's going down, it's not that gold is going to go up. There are periods when it goes up, but it's not reliable that it's going to go up. So gold is not, according to this, that useful a hedge for protecting your stock market positions. Okay, long run risk. Most of the risk management tools we've got, and the ones that I've shown you, are useful for trying to predict what could happen in the short run. And the problem is that's only part of what we're interested in. If we're a high-frequency trader, or even a day trader, or somebody that takes positions for a few days and then closes them out, that's the kind of risk I'm interested in. But if we're talking about investing in businesses, or investing by selling bonds and buying mortgage-backed securities or something like that, we're talking about longer periods, and the kind of volatility that we measure those previous slides is not really necessarily appropriate. You'd like to make those decisions based on measures of long-run risk, not short-run risk. And what is the difference between long-run risk and short-run risk? I like to use the phrase, there is another risk. There is the risk that the risk will change. So it might be low, but it could go up. That's the risk. So the fact that the risk is low does not mean it's going to stay low. And of course, if it's high, it doesn't mean it's going to stay high. It could go down. So what we're going to try to do is come up with a measure of what the long-run risk really is and taking into account the fact that the risk can change. Well, it turns out these volatility models that I've been showing you are ways of measuring how fast the volatility can change. So that's what we're going to do here. Now, one of the reasons we're interested in this is because once I got the Nobel Prize, people started asking me these hard questions. Like, if your model's so good, did it predict the financial crisis? Let's think. The first time I got asked that, I didn't know what to say. So eventually I said, I've got to do a little study. I've got to find out whether it could predict the financial crisis. It seems pretty unlikely that it could. So I went back with my actually then student, Brian Kelly. Some of you might know Brian. And we looked at VLAB because we had volatility forecasts done over time. We knew exactly what was being predicted from before the financial crisis to after the financial crisis. So every day we looked at what the forecast would be, and we compared that with what actually occurred. And it turned out the forecast volatilities went way up, and so did the realized returns. They were very, very volatile. But if you actually did your risk management carefully and you looked each day at how much risk you were taking, you were predicting you would take the next day, there was no deterioration in this model. So it was really very robust to this enormous dislocation in the financial markets. So we were all very happy about that. Until the reporter asked the next question, how far ahead did you know this was going to happen? And the answer is 1 day at a head. We could predict the financial crisis 1 day ahead with a lot of reliability. But, says the reporter, of course that's not the question, right? You need to be able to predict it further ahead than that. And I completely agree. So what that really means is that the risk management tools that we develop, that we teach in our risk management classes, that every risk management department in a major bank uses, is focused on short-run risk. And as a result, before the financial crisis, there was a whole lot of pressure on trading desks to increase the amount of risk they had because the risks were low. The volatility was low before the financial crisis. How do you make any money if you can't take enough risk? So they were trying to leverage up. It was an explicit objective many times to try to increase the leverage, increase the risk that you were taking, because without increasing the risk, you couldn't increase the returns. But I think they were confused about whether it was short-run risk or long-run risk that they really wanted to take. When they buy mortgage-backed securities and Europe's bought sovereign debt, these are illiquid, long-run investments, not short-run investments. And so when the financial crisis did hit and the risks went up, of course, these positions were positions they wanted to liquidate, but you couldn't liquidate them that fast. And we had fire sales going on these long-dated illiquid assets, which meant mortgage-backed securities were impossible to sell. So this is a kind of a story about the financial crisis due to what you might call risk myopia. Now, it's only one piece of the story probably, but I think it's a pretty interesting piece, and it's the reason why we're working on these long-run risk measures, to try to provide tools that the risk management industry can use for longer forecasts. So here is a prediction of what some of these long-run risks look like. So, for example, at the last date here, we're predicting, this is the DAX, I guess, we're predicting that a year from now, the DAX could be down as much as like 48%. And that would be true with probability of 1%. So this is the fat tail distribution, but one time out of 100, it could be as bad as this. Now, it's a little hard in your head to think about what that really means, because we don't get to see history go by 100 times and see what one of those really looks like. But it seems like it's sort of a reasonable number. And it comes from simulating with we estimate a Garch model up to this point. We simulate it over the next year, and then we look at the 1% quantile of those simulations. We do the simulation with by bootstrapping the innovations so that we have the fat-tailed innovations in this, and that's what we get. We also do it using implied volatilities, the term structure that the options market thinks is going to happen. And so the green one uses the options data. The black one does not use the options data. And as you see, they give you pretty much the same answer here. Although, in this period, it looked like the options market was considerably more pessimistic. They thought that the 1 year ahead 1% quantile was a lot worse than what the Garch model would do. And that's probably because, well, in this period, we were threatening to shut down the government. And the Garch model didn't know about it. But the options traders knew about it. So options implied volatilities were higher than what the Garch would do. And that's the information content that's in implied volatilities that's not in Garch. And that's why this is interesting to have both of them. Okay. So then the last thing I want to show you is just a little bit on systemic risk. And this turns out many people think is the most interesting and it's most novel part of this website. It's a particular part of the risk, which is the risk that the financial sector will fail again and leave us with another financial crisis. So one of the things that we've learned is that the financial sector is vital to the economy functioning, because when it essentially failed during the financial crisis, it shut down the real economy in a way which maybe people hadn't realized could happen. And then it happened again in Europe with the sovereign debt crisis. And so we really have two observations on how, heavy stress on the financial sector led to big declines in real output. So can we prevent this in the future? This is the regulatory challenge, and we're trying to contribute to this regulatory debate with a nice new gate that's got some hope of stopping the next financial crisis. Well, actually, let me skip this. So I'm going to show you a lot of pictures. And these pictures are going to be pictures of what I call S-risk. And S-risk, I have to explain to you really exactly what it is. It's the answer to this question. how much capital would a financial institution need to raise in order to function normally if we have another financial crisis? Okay, so we have a financial crisis. These banks are under stress. Do they have enough capital in reserve so that they can survive this, or do they need to raise capital? If the answer to this is they have enough capital in reserve that they don't need to raise capital, then the answer is S risk is 0. But if they need to raise capital, and they try to raise it in the middle of a financial crisis, it's hard to do. And that was the problem that faced Lehman. They needed more capital. It faced Merrill Lynch. They needed more capital, so they sold themselves to Bank of America. WAMU failed. Freddie and Fannie were both nationalized. The government, including Treasury and the Fed, injected money into most of the major banks in order to prevent them from failing, so that the most likely source of capital in the middle of a financial crisis might be the taxpayers. No matter what anybody says about whether they're too big to fail or not, the idea is, what is the need that might or might not be paid for by taxpayers? It might come from some other way, but the goal of the regulator would be, if the answer to this question is 0, then they have enough capital already. They're not going to need it. And in fact, if it's 0 for all financial institutions, we can't even have a financial crisis, because the firms would not be stressed. So I'm going to show you what these numbers look like. So we do this for something like 1,200 financial institutions around the world. For each one, we calculate every week what their S risk is, and we add it up. What's the total bill that the total global economy would need to provide to keep all the financial firms in the world functioning normally in the face of another financial crisis? And here's the answer. It's just under $3 trillion. It's a big number, but it's a big world too. It's a lot of companies, and what you see is it's a good bit smaller than it was a couple of years ago when it was $4 trillion, and what it was in the height of the financial crisis when it was also about $4 trillion. But it's not come down nearly as low as it was before the financial crisis occurred. So the answer is, from a global perspective, systemic risk is becoming less important, but it's not gone away. So where are all these risky banks? And where does this $3 trillion really come from? So the country with the most is today China. For a long time it was Japan, but now China has passed Japan. So it looks like China would need about $550 billion to bail out its banks. We know that they have foreign exchange reserves of maybe $3 or $3.5 trillion. This is not a major problem for China to do this if they should choose to do it. It is a problem that their banks are undercapitalized and are probably not functioning very well because of this risk. So China, Japan, France, United States, UK, Germany, Italy, Canada, Netherlands, and so forth on down. So these are the countries that have the most systemic risk. But of course, you might imagine that we should look at this number relative to the size of the country. So we can divide it by GDP, and we can look at the percentage of GDP that would be needed. And here you see that the most systemically risky country is actually Switzerland. The highest percentage of its GDP would be needed to rescue its financial sector. It's actually just this week that Switzerland went back above France. It had been France for 6 months or so that was number one. Now Switzerland is back in top, but both of them are about 13% of GDP. So if you ask, can we afford 13% of GDP to rescue our financial sector? Answer is no. Nobody wants to do that. A 13% decline in GDP is a big number. And that means the big risk here. So what's going on in the U.S.? Well, in the U.S., we peaked at maybe 900 billion. The TARP put in 700 billion. The Fed put in a few hundred billion. That's more or less what happened during the financial crisis. But now we're down to around 300 billion. It's only about a third of what it was at the worst. So things are looking, the financial sector in the U.S. is looking a lot healthier than it was before. Asia, however, is not. Asia is looking a lot worse than it did before. In fact, it had a bit of a peak during the financial crisis, but it's been pretty much increasing since before the financial crisis. And the two major countries in Asia which contribute to this are Japan and China. And what you see is Japan has mostly been increasing, although there is this drop at the end and a little bit of an increase here. So what do we call this? Well, people were calling this Abe economics. The Prime Minister of Japan has embarked on a big expenditure and effort to grow the economy, grow the jobs, increase inflation, and decrease the exchange rate. And this looks like it's successful. But there is a little turn up here. Do we count? Is that serious? You know, that's the advantage of having this updated regularly. You get to watch it and see what's happening. China, on the other hand, it's pretty steep up. They didn't really have any systemic risk at all before 2009, and now it's shooting up. And China is very concerned about this. They're working very hard on it. They've expressed a lot of interest in these numbers. There are potentially lots of reasons to think that the numbers may not be a perfectly accurate representation of China, but mostly it looks like, when you think about it, these numbers are probably too low. Probably the risk in China is greater than is revealed by these numbers, just because of the institutional structure. And what about in Europe? Europe is where we've been worried for a long time, and it does look like things are improving in Europe, but we're still well above what we were before the financial crisis. The ECB has done a major job of improving the sovereign, the distortions in sovereign bond markets, sovereign bond prices. And you probably saw on Tuesday that the European Union basically adopted a series of financial reforms which take bank regulation out of the hands of national regulators and put it, for the largest companies, into the hands of the European Central Bank, which I think is probably a very good thing and will mean that bank regulation can be stronger and more confidently accomplished going forward. And so you see this very optimistic drop in the systemic risk in Europe. And then there's Russia. Well, you know, Russia's systemic risk was always very low, but it's now shot up because as the stock market goes down, the valuation, the capital available to Russian banks has gotten smaller, but this is only 25 billion. It's not a really very big number. It's not clear to me that this is going to bring down the Russian economy at all, but it is an issue that they are going to be facing. During the financial crisis, Russia had no hesitation to recapitalizing the banks, and I'm sure they will do it again. So in the U.S., well, in each country, the total S risk is made up of the S risk for each of the banks and financial institutions. And so here are the financial institutions in the U.S., and here we have Citi at the top at about 47 billion, JP Morgan, Prudential Financial, MetLife, Bank of America, Morgan Stanley, Goldman Sachs, and so forth. One of the interesting things about this list is that there are a lot of insurance companies on it. And I think that's one of the things to pay attention to, that it is not only the banks that are systemically important to the economy. It may also be insurance companies. And insurance companies are moving up while the banks are moving down. We could look at time series for each of these banks, and you would see the difference between the declining S risk for the banks and the increasing S risk for the insurance companies. So when I talked yesterday in the econometrics seminar, I compared this type of list with what the Fed has done when they've looked at the stress tests. And these stress tests are now kind of famous because Citi failed and Zion Bank failed. And here you see Citi on the top of our list. I don't know, Zion Bank doesn't even make it onto this list, but that's because it's small. You know, it might need capital, but it's not very much capital. So it's a different criterion that the Fed is using from what we have here. But when you actually translate this into the kinds of capital ratios the Fed is using, the results are pretty similar. In fact, if you look at the ranking that the Fed came up with and the ranking that we came up with, it's like they're correlated maybe 60 or 70%. So there's pretty high correlation between these firms. And here's this kind of a picture of where the VLAB ranking is on the left axis and the Fed ranking is on the bottom axis. So you see we're talking about something where there's not a perfect fit, but they're fairly similar. So that the Fed uses all this proprietary information from the banks in order to come up with this ranking. And we use their stock market valuation and their accounting value of liabilities. So they're rather different. Ours is quick and easy. Theirs, and generalized all over the world. Theirs is intensive. And the fact that they correlate pretty well is encouraging for being able to get a monitor that looks where problems are and follows them over time.
I was particularly interested when you showed the S risk of the insurance companies.
Okay.
And I've recently read about this thing called shadow insurance, which is apparently a blossoming market going up to $350 billion now. And I was wondering if that in some sense has been taken into account, and eventually if you're going to do that. And second part would be if at some point you're going to publish a first or second derivative of this S risk metric.
When you say derivative, you're talking about a financial derivative or a mathematical derivative? Yeah, okay. Well, I haven't thought about the derivative with respect to the S risk. It's sort of so noisy that, it jumps around from observation to observation, so that I don't know whether the derivatives would be more informative than, you know, a smooth curve through it or something like that. But sorry, what was it? What was the first part of your question? I forgot. Oh, right. So the shadow insurance business is booming. I think that's what you're saying. That there are states which have weak regulations, and my understanding is that a lot of these insurance companies are setting up subsidiaries there so that they can sell back to a wholly owned subsidiary. They can reinsure their book against this. This allows them to reduce their capital requirements, and so I think what we see is that the official leverage is getting smaller and smaller for the insurance companies. They have equity which is a smaller share of assets than the banks do, and it doesn't seem obvious why that should be adequate for insurance companies when we don't think it is for banks. But part of that is that the market prices these insurance companies with knowledge of this risk. And so I think that the stock market, the analysts and so forth, are aware of this, and actually the market cap of insurance companies is going down. And one of the reasons the S risk goes up is because the insurance market cap is going down, so it looks like the equity, so it is the case that the equity is a smaller fraction of the balance sheet than it had previously been. So what does that really mean? It means that the market views the assets of the insurance companies as not as valuable as they used to be. And that's the advantage of a market-based measure, that you get to see that stuff happening just as time evolves, even though accounting numbers will only reflect this after some substantial amount of time, and maybe only after accounting regulations are changed, so that you've got to bring some of the shadow stuff back on the balance sheet.
I might be misunderstanding your asterisk measure here, but is there a nature, does it have a pro-cyclical component to it? As risk is going up during a crisis, would that not push policymakers to push banks to increase their capital ratios?
Right. So I think it's very clearly a pro-cyclical measure. If S risk is what regulators use to tell banks what they can and can't do, then clearly when bank falls on hard times, its S risk goes up, and regulators say, oh, then you've got to do something about it, and what they have to do about it might actually require them to sell assets which are good assets, and makes the situation of the bank even worse. So one of the questions is, can you design a counter-cyclical version, a policy in this context? You know, I don't think that, I mean, S risk is should not necessarily be equal to zero at all points in time. That's not really what regulators, I think, are going to do. I think what regulators are going to do is they're going to look at the economy when the economy is heating up, when there are potential asset bubbles developing in various sectors. It might very easily raise the requirements for the capital cushion. That would increase S risk for these financial institutions, and the institutions would then need to delever to solve this problem. So on the upside, it makes sense to increase capital requirements to slow the growth of asset bubbles or the economy as a whole. The downside is the side you're worried about, and is the side regulators are worried about. And I don't know yet whether I think there is a solution to that, but when the economy is doing badly, S risk goes up, do you at that point want to tighten or loosen the regulatory screws? And I think that there are reasons to be concerned that if you at that moment tighten the regulatory screws, you actually drive the economy even further down. So that what we do in monetary policy through something like a Taylor rule is that you actually loosen, but not too much. So that if you've increased your capital cushion in good times, then you can reduce it in bad times and reduce the downward spiral in the real economy. But quantitatively figuring out how to do that is a challenge, and that's actually one of the challenges we are really trying to figure out how to deal with. Thank you. Thank you.